I think in your hands, but I think we can probably make a start. Good afternoon to everyone. For those of you who don't know me, my name's Andrew Clements. And I'm the chair of EOA. For those of you who are looking through the camera, I apologise in advance that my bald spot flares on the camera. So that will be a distracting moment for you or any of you that have to look. I am absolutely thrilled to have Jon Shell with us today. I'm really looking forward to today's discussion because it's just a great opportunity. I would like, as we always do, to acknowledge the traditional custodians of the land on the various places that we're meeting today, and pay my respects to the elders past, present, and emerging. Jon, we were having a little chat before. I should thank you first of all from taking time out from your break and talking to us. This is a fantastic opportunity. For those of you who don't know Jon, he's Social Capital Partners, has been or was, and it still is, very heavily involved in the recent exercise in Canada in the significant reforms that they've had in terms of the introduction of employee ownership trusts in Canada. Jon's been an advocate for employee ownership for many, many years, and indeed is or was the author of a really cool paper entitled Building an Employee Ownership Economy. That was, I think, released, Jon, back in 22, but I think you mentioned to me earlier that it had been released earlier. And I guess the thing that struck me most about that report when I looked at it was the strong similarity in the items and matters that you'd raised in it. And I glibly made the response or observation that I looked at it and I thought I could clone and amend the reference to Canada, to Australia, and have a report that really dealt with the key areas of employee ownership. And I think probably the takeaways for me out of that were employee ownership matters, and there were some really cool empirical references to about the level of wealth of those employees engaged in employee-owned businesses, and then that. Unsurprisingly, that the model was successful, and it was a really helpful transition model. And I guess probably the last point, which is the one that I think we can get a lot out of today, is that we can look and understand and build from that which have been done in other jurisdictions. And given your current experience, I'm just thrilled to hear about the experience, the process, and I guess perhaps a little bit more about Social Capital Partners and what you do in the context of employee ownership, to probably give some context to our audience. So, Jon, in your hands.
Thanks, Andrew. Thanks everyone for joining. I'm always happy to talk about employee ownership, even on vacation. And it's only 9 a.m. here in Perth, so I'm not interfering with my family's plans all that much today, which is great. Look, first, let me set a bit of context in terms of employee ownership in Canada. Right now, it's very small. So we have, like most countries, we have 400 to 500 odd worker co-ops employing about 6,000 people. We have about 3 or 4 dozen majority employee-owned companies, some very large, some kind of billion-dollar construction companies, some relatively small, but that's not very much employee ownership. Certainly not compared to the UK and the US. But that is poised to change. So as Andrew mentioned, we are current employee ownership trusts will be a new structure in the Canadian Income Tax Act within days. It's just passing its final reading over the next week or two. And then last fall, the government introduced a promise to provide a significant capital gains tax incentive for companies who choose to sell, for owners, business owners who choose to sell their companies to EOTs. that tax incentive should drive a significant adoption of employee ownership over the decades to come. So we're at a place where it's very small and we're about to grow. I think the goal of this conversation is to explain, a little bit about how I think we got there in Canada, in case it might be useful to your work here in Australia. I think it's important to note that it may not be useful to your work here in Australia, right? I mean, what we've learned in this process is national contexts really matter. The process of getting to employee ownership is very different in the US, it's very different in the UK, it's very different in Canada. So some of this may be completely irrelevant. I'll try to, I think Andrew and I talked about leaving a lot of times for questions in case, there are particular areas that might be more relevant than others. So I'll start by saying I acknowledge that none of this may be important to you, but hopefully there'll be something you can get out of it. Social Capital Partners, where I am chair, I was managing director up until end of last year, and during this process, managing director, now chair. It's a nonprofit based in Toronto, Canada. Our objective is to reduce wealth inequality. We come to this issue from the vantage point of increasing access to ownership for people who don't otherwise have access. So we focus on a lot of issues. We talk about housing. We talk about business ownership. We talk about entrepreneurship. We talk about all of the different ways that people who don't have access to ownership can get access to ownership as a way of reducing wealth inequality. And a few years ago, probably 5-6 years ago, we did a project to try to figure out what were the most powerful tools in the world towards broadening access to ownership. And it was a surprise to us that we found the most powerful one in the US, and that is the American version of employee ownership, which is the ESOP. And we were fascinated by how large it had gotten. There's 14 million Americans sharing, and now almost $2 trillion in wealth in the companies they own through an employee stock ownership plan in the US. Tracing it back to its history of creating the structure and creating incentives, we thought, boy, this is incredibly powerful. And then the research also introduced us to what was happening in the UK, where when we started looking at this in 2018, the UK was just starting to get to a point where employee ownership was taking off. So there, I'm sure a lot of people on the call know this, but in 2014, the UK introduced their version of the EOT, which introduced both the structure and tax incentives for business owners there. And, in 2018, it was kind of getting to an inflection point where people were really beginning to use this model. And now, it's helped us that in the time in which we've been advocating for this in Canada, the UK's gone crazy to the point where on a per capita basis, there are about 8 or 9 times as many employee-owned companies created in the UK every year as in the US, right? So the 300 odd EOTs built in the UK today, every year. So, maybe what I'll, so that caused us at Social Capital Partners, and we're independently financed by myself and my business partner, Bill Young. He and I both have a history of business entrepreneurship that has been relatively successful. Just as a bit of Australian, cred, I built a business here between 2013 and 2016 that ended up becoming the largest provider of veterinary services in Australia and now New Zealand. My wife is Australian, so we spent 3 years here, and that's the business that I did while I was here. And so both Bill and I look back on our careers and say, boy, we had access to ownership in a way that most people don't. What are the ways that we can broaden access to that opportunity and to that luck? And so he and I decided that we'd focus our efforts on employee ownership. 2 things were clear to us. One, there was the ability for there to be even more employee ownership in the US, where we decided to actively engage, and that Canada needed a structure similar to the US and the UK so that it could grow in Canada. There are some major obstacles to employee ownership in Canada. The first being what is called the 21-year rule for trusts. And I don't know if that exists in Australia, but the way it works is every 21 years, a trust needs to effectively pretend like it's being sold, so a deemed disposition, and pay whatever capital gains tax or whatever taxes are appropriate for their current value at that time, which makes it an employee ownership trust structure very difficult. The employees don't, and the company doesn't have the cash, won't have the cash every 21 years to pay off that tax bill. And so it creates a bunch of problems for owners who are looking to sell indirectly to employees through a trust. And we have no tax incentives. So whereas in the UK and the US, their growth always followed tax incentives. I mean, you can trace the growth in the UK and the US directly to the introduction of tax incentives. We know that the UK prior to 2014 had a compelling structure. This is what our research showed, had a very useful non-21-year rule, like a useful trust structure. Nobody used it because there were no tax incentives. So we knew that if Canada were to have a structure, it needed to both get rid of the obstacles, things like the 21-year rule, and we needed to introduce tax incentives. And so, as Andrew said, in 2020, we produced that report called Building an Employee Ownership Economy. It laid out the three things that we thought were necessary in order for there to be employee ownership in Canada. One, that we need the structure. Two, we needed incentives. And three, we needed regulations to make sure that employees and taxpayers were protected, and this didn't end up being some sort of tax dodge for business owners. And so those, and I think that third point was actually really important because it allowed the government to take us at our word that we cared about this for the right reasons, right? This wasn't us trying to figure out a new way for businesses to reduce their taxes or business owners to reduce their taxes. This was really about the worker for us. And the government believed that because we were so clear that the regulations really matter, that it had to be well thought out in terms of its presentation. So we introduced that report, and really there were four different steps on our path to the legislative successes we've had. And I'll briefly walk through them, and then I'll stop and give a chance for Andrew and others to ask questions. But first was presenting a clear fact base and a compelling story. So the report that Andrew referenced talks about the success in the UK, talks about the success in the US, gives all the reasons for it, very detailed in terms of the outcomes, right? So politicians were able to pick and choose the things that were most important to them about the success of employee ownership. And that was a useful base that no one really challenged. So we built and owned the fact base, and we told a story that people liked. What was interesting to us is the things that mattered to politicians were not necessarily what we expected. So we thought this was really going to be about inclusive wealth, and it was for some. But for a lot of politicians, the most important thing was succession. That they knew from their ridings that there was this real issue with businesses that were important employers in their regions that didn't have a succession plan, and they were worried about what was going to happen. And so by providing a new option for succession, that was interesting to a lot of politicians. And the second one, which surprised us, was Canadian ownership. Right, that wasn't even on our initial list, but as it turned out, there is a real fear and a real logical fear around primarily American companies buying Canadian companies. And so the idea that EOTs kept ownership Canadian was really important to politicians. And worker wealth was, of course, important. There's a realignment politically all over the world around worker wealth and the topic of ownership. And so that hit on those topics. But the story told all of those things, and they were compelling. So that was kind of the first important thing that we did. The second was becoming a reference group for government. So that first report led to enough conversations and enough support among governments for us to be included in the 2021 Canadian budget. So they said, yes, we will investigate this employee ownership trust topic. We think it's interesting, and we'll get back to you. That was essentially what that did. And after that, it really became about working with the bureaucracy. So the government punted it to the bureaucracy, the civil service, and said, okay, figure out this employee ownership trust thing and get back to us. And they really didn't like the idea at first. They didn't think it was necessary or important. They worried about how it would be used. And they had no background in it because it hadn't been a topic before. So you have people who are used to knowing about every topic that they're asked about, right? And having an answer at the ready, being able to research it simply. This was a completely new topic, required starting from scratch. And because we spent the most of 2021, the summer of 2021 and the fall of 2021, sending memos to the bureaucracy on different aspects of employee ownership, for how to protect against fraud, to how to create the right structure that gives voice to employees, et cetera, et cetera. And that allowed us to become a reference group for both policymakers and for the civil service. So they would come back to us for questions, not as often as we wanted, but they were, we were the ones out there. I mean, it's not exactly a crowded space. It wasn't hard for us to be the ones, but we were the ones that they would turn to for questions and for research. That led to them agreeing that at least employee ownership trust was possible. And in the budget, in our 2022 budget in Canada, they upped the ante and said, we are committing to bringing employee ownership trust to Canada with no details at all. So they said, okay, we're going to do this thing, and now we have to figure out the details. And then so the bureaucracy had to go away and write out legislation. That next year was a bit worrisome, right? To be honest, we knew that they were working on something. We didn't know what it was. We were worried it was going to be bad. They weren't taking as much input from us during that year as they were doing their work, and so we shifted our focus to the third thing that was really important, is building a large and compelling coalition. So in the time that we had been talking, to journalists and doing webinars and trying to be as many places as we could about employee ownership, a lot of people came out of the woodwork in Canada saying, we think this is a really good idea. And that allowed us to build what we call the Canadian Employee Ownership Coalition, which we have a website. We have almost 100 people on it. They are CEOs and leaders of associations and nonprofit folks and academics, all united behind the idea that not only do we need employee ownership, but we need it in this specific way. So we were able to lay out 3 or 4 specific things that we thought the legislation should look like, and we had these people standing behind it. When we introduced the coalition in January of 2023, right, about 3 months before our budget, we were profiled in the equivalent of the Sydney Morning Herald. We had a whole set of articles written about it. And so for government, there was now this coalition that cared about this. It wasn't just us. And so it built the pressure a little bit to do something good with the legislation. That led to the 2023 budget, where we finally got legislation. Here's what we want to do with employee ownership. And it was an absolute and unmitigated disaster. Right. The proposed legislation was so bad and so unworkable that we were ready to just dump the whole thing. There were no tax incentives. The structure was a mess. Because we had built the reference group, because we had built the coalition, we were able to go to government and say, listen, this thing that you've put out is unworkable. We will be coming out against it. If you actually want us to support you, we need to do a lot of work to fix this. And they responded by saying, okay, it wasn't not initially, but they said, we understand that this is a problem, what we've introduced. Give us some suggestions. And over the course of the next 6 months, we worked with government to fix it. And so new legislation was introduced, and that's the one that you see today, which is actually a pretty good structure. It's a bit of a hybrid between the UK and the US. We can get into the details if you'd like, but it's a pretty good structure that we're quite happy with. And that brings us to kind of the last thing that we did, which is we left no stone unturned. So we were everywhere, right? As much as we could. If anyone wanted to talk to us about employee ownership, we met with them, with politicians, senators, journalists, even business owners. We probably spoke to 3 or 4 dozen business owners who were interested in the topic, even though we knew they couldn't do anything with it yet. Getting their feedback, getting their support was really important. And when it came to legislation, that led to the very last key to the puzzle, or piece of the puzzle. You don't have keys in puzzles unless it's a puzzle with keys. And that was last September, when it looked very much like we were going to get a structure that would be workable without any tax incentive. And what we had been advocating for was the UK approach to the tax incentive. It's a very simple structure. If you sell a majority of your company to an employee ownership trust in the UK, you pay no capital gains tax. Simple as that. And that's what we wanted. The bureaucracy hated this idea. like hated it with a passion. They thought it was too expensive. They thought it was unworkable. They were worried about the implications that larger, very large businesses who weren't genuinely interested in EOTs would find some way to trick them into getting this tax incentive. And so it felt like a completely unbounded solution set to government. And we recognized that this was happening. And at the very last minute in September of last year, threw in this new, we negotiated against ourselves because we were having no conversations with government about this, a new idea that we proposed that the first $10 million in a sale to an employee ownership trust be exempt from taxes, and the rest would pay capital gains tax as normal. And that ended up being workable for both the bureaucracy and for government. So last fall, the government said, yes, we will do that. We will introduce a capital gains tax exemption on the first $10 million of capital gains on the sale to an EOT, which means the majority of the company gets sold to an EOT. And we'll introduce that. So that hasn't been introduced yet, but that's has been what's proposed. It's a savings of about $2.5 million for most owners if they take the whole amount. Our capital gains tax rate is 25, 26, 27% ish. So where we are today, like I said, the structures will be in place soon. We expect in the next budget, we are my fourth time waiting with bated breath for the Canadian budget to be introduced, which is something I've never ever done before, but now it's kind of become a habit. In this next budget, we expect the legislation around the tax incentive to be introduced. That will be really important. If it comes out super complicated and super restrictive, then all of this will have been for naught. But hopefully it will come out simple enough that people will decide to use it. So that's where we are in Canada right now. If they do put out a simple incentive program, we do believe we will see a ton of growth here. It's been it's felt like a long time for us. We understand from those who do more of this political work that it's been relatively quick. But why don't I stop there? I've actually talked longer than I wanted to.
Alan had a really interesting question, which in a sense is a little bit of a question of comparison between jurisdictions. And it reflects that there are economic and social advantages of employee ownership. Australia has a very low rate of employee ownership.
Yeah.
I guess the twofold question is that something that can be explained simply by lack of good public policy, or are there cultural issues that you think were the problem? And what was that mix in Canada? I guess before I give you a chance to respond, to perhaps give a little bit of nuance around the lack of public policy around employee ownership in Australia. If you went back into a time capsule, and you went back to the late 90s, there was a lot of employee ownership structures that were exactly, John, as you alluded to, were matters that were not about employee ownership, but were ostensibly about generating a tax benefit, which then meant that our regulatory regimes responded to that integrity issue strongly and boldly, which then created the dogma that I had in my mind, which has been there for a long time, that the legislation was there to prevent, not promote.
Yeah.
So I guess from your question then, in the context of that, sort of public policy versus culture, and balance between both or either.
Yeah. So I want to say two things about this. One, which I'll get to in a minute, about a culture of the bureaucracy, but the first around the evidence. So all of the evidence suggests that it's entirely public policy and zero culture. And the best example of that is the history in the UK, where they have actually had a pretty proud and well-organized employee ownership advocacy community for 3 or 4 or 5 decades, right? They have something called the John Lewis Organization, which is a 90,000 person retail company that's is now 100% employee owned. We'll see how that goes. They are in some strife, but has been 100% employee owned for, for 100 years or something. And so they've had this, but if you go back to 2012, they had very little employee ownership. So their culture clearly was around it, right? They had a pillar to look up to, yet it rarely happened. The time it happened was when they introduced a tax incentive, right? That's when it happened. And it's like, it's dramatic, right? There's like the stats, and we wrote a report in August of 2022, estimating the uptake of employee ownership in Canada if we had a similar approach as the UK. And so we went back and studied the history in the UK, and with a lot of help from folks over there, Andrew Robinson, Graham Nuttall, they're wonderful folks and have been really helpful to us. But you had like 5 to 10 employee-owned companies created every year in the 30 years prior to 2014, and now it's 300. And the only explanation for it is public policy, a structure, and tax incentives. So on that, I think culture is irrelevant. I think it's entirely a public policy. And where culture is relevant is in the bureaucracy. So all of our bureaucracies, I believe, have scars. Okay, all of our finance ministries, and they carry, because no one ever leaves, they carry these scars over time. So our scars are related to something called the income trust, right, which was a particular Canadian a structure that was used for tax avoidance, right, that was shut down just after 2010. And our bureaucrats are scared to death about repeating that. There's a couple of other things. So there are scars in the bureaucracy that you have to overcome by telling a story compelling enough to politicians that they tell the civil service that they don't care. That yes, there's a thing happening. I don't care about that thing. This is a new thing. We can create it and regulate it in a way that doesn't allow for what you're worried about. And so let's go and do that and stop whinging. So I guess that's my feedback from my Canadian experience.
Yeah, I mean, your observation about scars is really interesting, and because certainly at the level of private employee ownership, the level of complexity that we've had for a long time is very, very high, and a large slab of what what we've been trying to do as an organisation, John, is I guess a couple of things. The first is raise the level of awareness of employee ownership trusts, so people understand the context of it as being an unallocated plan rather than the conventional allocated plan that they're used to. But the next is the initial point has been at a very minimum to create a level playing field, so that if I have a founder who wants to exit, at least exiting through an employee ownership trust is as good as, or gives the same outcome that they would have got if they were selling it off to a third party. Which kind of brings me then to, you mentioned business succession, and how important has that been as a sort of institutional driver, not so much from government, but by business and institutions that see that business succession issue as a really big one and something that needed help, that moves it away perhaps from the traditional exit mechanism. It's I give it to private equity or I sell to a competitor.
Yeah. Look, we have a small business group here, which is quite large, that has put employee ownership trusts on their to-do lists, right? Something that they think is important for succession. Succession has been far more important to politicians, really, than to the business community. The business community will talk about it, but they haven't done much here to try to fix the challenge. But politicians do care about it. So I'd say it's been an important point in our narrative, in our story to politicians, and journalists get it. I mean, the stats will be the same in Australia, I'm sure, where 75% of people are selling their business in the next 5 to 10 years, baby boomers retiring, etc. So, I think it's an important part of the narrative. The business community itself, it wasn't that relevant.
Okay, because it's interesting that certainly there's a strong narrative around succession, but I must admit the surprising thing, and I think you alluded to it, is retention of enterprise and businesses regionally in particular sectors, and that's been the area that has surprised us, where the take-up has been stronger. And I was wondering whether you'd seen a similarity in the types of industries and sectors that were expressing an interest in employee ownership in Canada, whether they were reflective of the same sectors that had shown interest in the UK.
I think it's too early to tell, but I'll say this: your regional point is the most important one there, at least in Canada. None of the companies that have approached us have been based in Toronto or Montreal or Vancouver, right? They have all been in more regional areas they're worried about selling to some kind of Toronto financier. I'm from Toronto. I am a Toronto financier, right? You don't want to sell to a guy like me, right? So, and politicians get that, right? I mean, most politicians are not from Sydney or Melbourne, and so will care about the regions and keeping businesses local, and that's been incredibly powerful for all parties, right? They all care about that. And so, there's pushback on the tax incentive, but to your level setting, or to your point around a level playing field, if you walk through how an EOT works, where me as the owner, I'm largely going to be lending money, right, to make this thing happen to the company. So I'm taking on a lot of risk. I'm getting paid over time as opposed to right up front. So I don't get a clean exit. There's a lot of reasons not to do it. Right. And so unless you introduce a reason to do it, it's not going to happen. And I think people get that, right, and get why that's important.
Can I just pick up on that? Because I mean, that I think is a really interesting structural question in terms of the Australian market. And I guess pick up two threads there. The finance coming from, in a sense, vendor finance, firstly, versus external finance. And then the pressures that exist transactionally to do a transaction where you match the cash and the taxing event. The reason I dwell on that, Jon, is the two, for those of us who are working through the EOT structure in Australia, the two great dilemmas we have are this, and it's a conflation of tax rules. The first is once you sign to dispose, you're taxed irrespective of when you get it. So there's no deferral mechanism that enables a convenient mechanism for the founder to exit without having a complete taxing event on the disposal. So we then need to have kind of scaled exits. That then creates problems because of our rules around making sure that the vendor can provide that finance in a way that's not, if I can call it, tax offensive. So it then takes you to the other end to it is, I'm interested in your comments on this, the balance between vendor finance as against third-party finance, and in what's your expectation in the Canadian market as to the blend? Is it binary, or is it a blend of is it vendors external and a blend?
So it's hard to know how that will play out. The US has a very healthy third-party financing sector for ESOP financing. A couple of Canadian banks are quite heavily involved in American financing, but the UK doesn't. For reasons that I sort of, we kind of understand, we kind of don't, but the UK is almost entirely vendor finance. So we think Canada will be somewhere in the middle of that, where we'll have more commercial loans for these structures than they do in the UK. And it'll be a bit of a mixture for some companies, but I think the majority of companies will mostly be vendor finance. That's my guess. I mean, going to get a loan, but importantly, Andrew, to what you said, is we do have, and so we've always had a structure where you could allocate your capital gains taxes over a 5-year period, right? As long as it was at least 20% per year, if that matches the cash that you get. And they've extended that to 10 years for the EOT. Because we already had the 5, the 10-year isn't that big a gift. But that, it sounds like you have in Australia your own structural challenges, similar to our
Yes.
21-year rule, that create tax problems for either the owner and obviously those need to go away in order for this structure to work. My understanding as well is that a lot of the businesses, if I remember right, I can't remember the details exactly, but you have a much more generous tax incentive for entrepreneurs, right? So I think if you've owned your company for 15 years or so and your revenue is less than $6 million or something, you don't. So I think there's a lot of
So it's interesting that there's a very strong focus on that side of the market. We equally have strong CGT concessions around small business and vendors of small business, but most of them don't fit within the sort of if I can call it installment-based sale for a vendor finance. So for us at the moment, there's I guess a little tension, and that there's a question in terms of to what extent is it, is the engagement of institutions important to see this as a market that they would lend into?
Yeah. So one of the most important moments in our path was when one of our major banks decided to take this on as a really big part of their government relations program. So the Bank of Montreal, which is one of our 5 or 6 large banks, they are a very active lender to employee ownership in the US. And they want to become that in Canada. So they have been a very important ally in this. And building those, I mean, that's, I would say, while we were talking to governments, we spent a lot of time with people who we thought could be powerful allies of ours, whether it be, the Canadian Federation of Independent Business, which is that small business organization I was talking about. And they ended up running a poll for us that was important. The Bank of Montreal, we had an accounting firm and a law firm, like kind of a leading accounting firm and law firm jump on board. And so those were incredibly powerful allies that have helped. And so if I can, so that is incredibly useful, finding those allies and bringing them close.
Can I just take you to a slightly different place? And apologies because it's descending a little bit to the detail, but it goes to really the protections that we've been looking at around this. And a lot of the thought that we've given to it has been around making sure that we've got something that has tax integrity, first of all, but the other part was around governance and what the governance arrangements are for the employees to actually generate a structure that is strong and works. And a lot of that, and the traditional approach that we've tended to look at in the context of our arrangements has been an aggregation of 3 elements, which is representation through the EOT of both the founder, employees, and then with an independent chair to, in a sense, keep the structure online. I noticed the approach in Canada looked to be a little different.
Well, it's not that different. And we think it's actually okay. The requirements in Canada for the trustee board and for the company board. So the way it'll work in Canada is the EOT obviously is a trust. That trust will have a trustee board, and then the company will have its own operating board. Both boards need to include at least a third employee representation, and both boards can include as much as 40% representation from previous owners. So I think a common structure will be 2 employees, 2 from previous ownership, and 1 independent director. But you could have only 1 employee as the trustee. That's possible, but you couldn't have just the previous owner or just an independent, or you have to have at least 1/3 employee representation. And then the other thing is that employees only get a pass-through vote, right? So they only get to vote as one member, one vote on two topics. One is the sale of the business, and the other is the sale of part of the business representing at least a certain number of employees. So there is employee representation, but they don't control, or they don't, necessarily have to control either the trustee board or the operating board.
Perhaps just to take you to a slightly different place again, you talked about and I sense there was a level of challenge with it, about actually getting inside the process and helping guide the process to ensure that the model that you were producing was robust. And I guess question for you, having seen the experience where perhaps the first iteration wasn't, to use a provocative expression, as cool as it might have been. If you went back on that journey again, is there something you would have done different to try and frame the model to give clarity as to what the governance structure could have been or should have been to develop it more?
I don't know. We had provided all sorts of advice at that stage. And I think the eventual model that came out was a last minute thing. I think that I'd say I don't know that we could have caused that to go in a different direction. But had we not established the Canadian Employee Ownership Coalition, we wouldn't have been able to fix it.
Yeah.
Right. So we had enough of a profile at that stage that our message to government that we are going to come out against this and call it the worst idea we've ever seen, unless you commit to us that we will work with you to fix this. And that carried weight because that's what we would have done. So that I think was critical. I don't know that we could have caused that. It was crazy, like Andrew. Like if you go back and look at that legislation, like it was, there was elected directorships. It was every 5 years there were new elections. No indication as to how you're going to do these elections. I mean, it was nonsense. But they were open to feedback, which was great.
Yeah, because I mean, in terms of we spent a lot of time looking at and thinking about generating a governance model, because we're not working at the moment within a legislative framework. I mean, in a sense, John, we're in the United Kingdom, and we're at 2010.
Yeah,
and we're at the moment without legislative support. What we're doing is trying to generate a commercial tax equivalence, so that we're able to at least have an equivalence to affect the transaction. And I think your strong messaging to me is, Andrew, equivalence is really cool, but it doesn't put it on steroids.
Yeah, look, I mean, I think if we look at and Canada, of course, has not been successful yet, so we'll see. Maybe nobody will use this damn thing, but if you look at the paths that the US took and the UK took, right? The US had a person who was embedded into the process, Louis Kelso, in the mid-70s, who was able to guide. The US is different because external people write legislation all the time there. It's crazy, but anyway, he was able to guide that process very, very specifically. You had Graham in the UK who was able to guide that process very specifically. In our example, you had our group that became a reference group. And in each case, there was a legislative process by which something new was introduced, and then things could be attached, that new thing appropriate to that country. Our process is not the product at the end of the day is not an EOT as you would understand it, right? It's not a profit sharing trust. It's either profit or capital. There's a bunch of flexibility to it. It has a lot of ESOP features in it that we think are super important and we're very happy about. So given that we have a legislation, I mean, you now have a third example to point to say, look what's happening in these other countries. And that would be my starting point. I would providing completely unsolicited advice, knowing nothing of the context, being an arrogant yank or whatever. I would throw everything out and say, what's the campaign look like, right? For us to shift political views on this using a coalition of people who care about it. The fact base is out there. It's even stronger now because the UK actually has a fact base now. Back in 2020, even 2022, there's no evidence of impact in the UK other than the fact that these things were happening. Now they have evidence of impact that you can add to the US. It's a very powerful message. And so I might step back and say, how do we build a campaign against the best possible approach to employee ownership for Australia? And not worry about some of the stuff that might take 10 years to fix a tax thing. It's almost easier to come in over the top, right? And do a bigger program.
Certainly for our audience, if you've got questions, please put them through. One of the things I did notice.
Can I just say, Andrew, there are questions. Should we be looking at those?
We've covered a number. One is I guess a question in terms of worker co-ops.
Yeah.
And I'm interested in Canada and the relationship between worker co-ops and the work that you've been doing.
Yeah. Look, we haven't worked together. This is Anthony who asked this. We like each other, are aware of each other's work. I think my expectation is over time, worker co-ops will gain access to these incentives in the same way that in the US, they've gained access to those incentives. I think to have worker co-ops, it depends on each country's context. But if worker co-ops invoke the image of one person, one vote, and if we're talking about, the problem we're trying to solve with EOTs in Canada is succession of companies between 25 and 250 employees. And if you say we're going to solve that succession problem with worker co-ops, you can lose some credibility because it is very rare for a business owner to sell to a worker co-op a company of that size. It happens, but it's rare because it probably requires a significant change in how that company runs. And so the virtue of the ESOP, the EOT, ours is the independent ownership through an EOT. That's easier to sell. But my strong belief and my strong hope is that worker co-ops will gain access to these over time.
Yep. The other question I think was around a view that there is sort of institutional resistance to more cooperative workplaces in Australia, and I guess question as to whether that was something that you had to look into in Canada, and if it was, whether you had any particular observations around changing that mindset
around co-ops.
No, around the sort of, if I call it institutional resistance to cooperative workplaces.
Well, we are not offering a cooperative workplace. So the EOT is not a cooperative workplace. And I think that what we learned from our study of the UK and the US was that the demand was not for business owners can establish cooperative workplaces if they want. But if you're looking at a succession context, which is what we were looking at very specifically. How do we broaden ownership in a succession context? Because that's the big challenge that we face. That's where all of the ownership is going to shift. There's very little demand from business owners to shift to both sell their business and at the same time shift to a cooperative workplace. To me, those are entirely separate discussions, right? And so we didn't engage. We didn't engage in that. It just didn't come up. It's not part of our solution set. Do we think cooperative workplaces are good ideas? Depends on the company. Can be. Sometimes it'll work, sometimes it won't. But that's for each individual company to figure out.
I mean, picking up a little bit on a kind of nuance of the workplace. One of the things, and I was like, from the outside, it looked that the Canadian measures don't look to provide much flexibility in terms of gig employees, and a big issue in the Australian market at the moment is the delineation between employee relationship and gig employees. And as a result of that, a lot of our thought process has been around making sure that when we create this structure, it is, if I can call it, not employee relationship centric. And I didn't know whether politically that had been a big issue in Canada.
No, I think the gig, so speaking from my Canadian context and having done some research into this in Canada, the gig issue is vastly over discussed. The bigger issue is contract employees, right? Where owners, like companies, will move employees off books into a kind of a contract situation. There's nothing in our regulations that prevents a trust document from including either gig workers or contract workers, but it's not required.
Yes.
The employee ownership trusts and ESOPs in the US have largely been successful for long-term employees, right? This is like, how do we get this structure is designed to grant ownership and provide the benefits of ownership to people who stay with companies for a long period of time and devote a lot of their careers. Now, we get that that's not as common as it used to be, but it's still pretty common, right? It still happens. And so we love the stories of grocery clerks that retire from Publix with $1 million in their capital account and get to actually get all that money. I mean, that's incredibly powerful, and that's the objective that we have with this. It doesn't solve all problems, but we entirely ignored the gig situation, and I think that was the right call. Jessica, you've asked a question here around engaging in the actual legislative process. So let me just say the question: to ensure that it stays on track with achieving the joint aims of a genuine and significant tax incentive without being seen or used as a tax dodge. This was incredibly important to us, right? We are a nonprofit dedicated to reducing wealth inequality. If we are the main proponent of a structure that ends up being used as a tax dodge, it's a disaster for us. And so we spent a lot of time studying how people would use it as a tax dodge, right? What would you do? We talked to probably, I don't know, a dozen different accountants across the country that did structuring work for business owners, and said, okay, if this was on the table, how would you abuse it? And they kind of gave us a list. And so we ended up writing a memo of the 6 different ways we thought you could abuse this structure and how to ensure that none of those happened. And I think the result, even deals with some of the issues they've been having in the UK around offshore trusts, around private equity, buying post transaction. And so we've addressed, and those are issues that we think the UK will address. So part of it, so there's been 2 aspects. One is our work trying to identify what those things are and provide solutions for it. And 2, looking at the US and the UK and how over time they've addressed those issues and ensuring that ours was set up properly from the start. I don't know if that answers your question appropriately, but please follow.
Perhaps if I could, Don, just shed a light on that for the audience as to, we have been very, very focused on that as an issue. And indeed, the mantra is, the legislation should promote, not prevent. Firstly, that this is a low cost, easily accessible business structure that is not generated to provide particular tax outcomes or benefits. And a large slab of what we've then been doing has been around making sure that's the case. So I guess, for our audience, what does that look like? Well, first of all, it's been around making sure that the participants in the employee ownership trust can receive dividends by way of distribution. But in order to do that, we've needed to make sure that we can get a particular tax concession because of the nature of the trust. And as part of that, the critical element is, and the gain and the income must go to the employee personally. So there's no income splitting element to it whatsoever. That's the first. The second part of the structural element we've been looking to has been to reflect, in a sense, John, the outcome of the UK, which is or was a tax-free element of some bonuses. So that we have within the Australian context a $1,000 exemption plan, so we can provide $1,000 tax-free to an employee each year. So through the context of, if something is a complying employee ownership trust, it would make sense that you should be able to then provide $1,000 bonus tax-free.
Sure.
The third element is the one that I alluded to, which is the matching of the time of derivation of cash and the taxing point. And I think there is merit in us looking at the sort of matching that you've looked at, which is a sharing of the tax event over a period of time.
Yeah.
So I guess to give our audience an idea of what it is that we've been talking to, that's it. Our focus has to date been through the political process. We've, in a sense, been influenced to deal with the ATO, been very helpful, but in a sense, we need to show that this is a vibrant structure for them to put resources to it, which is kind of hard because it's a chicken and egg thing. So I think certainly what I'm hearing today from you very clearly, Jon, is to show the benefits of employee ownership, to show the benefits of this kind of structure and the adoption in the UK and now in Canada, and learn from those processes.
Yeah, I think so. Look, I mean, the outcomes are pretty spectacular, and politicians should care about it. And now we're coming up on an election in a year's time, and I'm getting messages saying, "Do you think there will be some of these so we can go cut some ribbons and shake some hands and kiss some babies?" And so it's becoming real for them, which I think matters. I think I don't know, like the door was open for us, when we positioned the story in a way that was compelling for politicians, and hopefully the door will be open for you too here.
Yeah, thank you. I'm just conscious of time and finishing on time. Can I just thank you, Jon, for your time today, but also for your enthusiasm and guidance, because as a group, sometimes our enthusiasm can wane, and sometimes we need to see someone who's had the desire and pursuit and persistence. So thank you for showing that to us, and I think there's a lot that we could learn from your experience. And please, for the audience, if you do have an interest in the area, to use the wonderful millennial expression, please reach out to us, and we'd be very happy to talk to you. So thank you, Jon, and we'll look forward to talking to you further.
Thanks, Andrew. Thanks, everybody. Bye-bye.
See you all soon.